Well, Canadian inflation cooled to 2.3% in March, but will it be enough for the Bank of Canada to cut rates at their decision tomorrow? Joining us now to discuss is Robert Both, Senior Macro Strategist with TD Securities. And Robert, welcome to the show.
Thank you, Anthony. It's great to be back, and especially over the last couple of weeks, there's never a dull moment and plenty to talk about.
Absolutely, never a dull moment. So I mentioned we've got the inflation numbers. What's your take on the latest reading?
So the March inflation data was considerably softer than we and the market expected. We were looking for total inflation to stay unchanged at 2.6% year over year. The market actually looked for inflation to tick a little higher to 2.7%. And there was very good reason to think that inflation could move higher. You did have all of these tax cuts that were in place over December and January. Those have been rolling off, so we saw some of that in February. We saw more of that in March. And you also, offsetting that, you did have a pretty large drag in gasoline, but what we saw was a very sharp pullback in some of the travel-linked components. So things like airfares, things like hotels, those really contributed a lot of the weakness we saw in this report. And if you look through some of that, the Bank of Canada's core inflation measures, they were a little closer to what we in the market were expecting. The two that the bank puts the most attention on, the trimmed mean and the weighted median, those fell by just a half or less than a tenth of a percentage point. They're now sitting at 2.85% year over year. So overall, it is closer to the target. That is going to remove some of the obstacles to the Bank of Canada cutting rates further. But we don't think that it's necessarily going to be enough to see that materialize on Wednesday.
Now, you also mentioned the impact of HST return as well as the carbon tax. That's had some impact on the numbers as well.
So the HST was certainly impactful. You saw that both in February and you saw that again in March. So that has really been concentrated across two major components. One is restaurants. So it's about 6% of the overall basket. Restaurants in Canada, it's been a great time to go eat out over the last couple of months. It's gotten a little more expensive over February and March with that HST added back on. And the same is true for alcoholic beverages. So in November, before these tax cuts kicked in, restaurant inflation was running at about 3% year over year. Alcoholic beverages, whether you buy them in a liquor store or at a restaurant themselves, those were closer to 2%. They did dive sharply into deflation territory, but now they're more or less back to where they were before those tax cuts kicked in. And while we did see a bit of a drag from softer gasoline prices as well, we're really not going to see the impact of that carbon tax coming in until the next report for April. So once you do see that April CPI report, we are going to see a very large drag from gasoline prices. I'm sure everyone who drives frequently has already noticed this, but that is going to shave about 10% off the price of fuel in April. And when you combine that with some of the other energy components that are going to see relief as well, natural gas, heating fuels, that year-over-year inflation rate can move sharply lower next month as that kicks in. So while we were looking for headline inflation to go from close to the mid-2s back to 2% in April, with the downside surprise on today's report, that increases the risk that total inflation could actually be dipping back below 2% next month.
I think one of the big questions for investors, consumers, is tariff impact. Are you seeing any signs of the tariff impact on the numbers, and what will we be watching going forward?
So we were certainly watching for the tariff impacts in this morning's report. Canada imposed about $60 billion in counter tariffs over the month of March. So half of those were introduced around the start of the month. Those were targeted towards consumer products that might be a little more politically sensitive. So a few on the chart behind you show peanut butter, Florida orange juice, coffee and tea. These were all measures that were targeted with counter tariffs. But you didn't see much of a acute spike in the month of March once those were put in place. The tariffs we saw introduced later in March, those were a little more skewed towards industrial products, steel and aluminum. They were designed to match U.S. tariffs there. we also saw them applied to some more intermediate products as well. But as you've seen over the last couple of weeks, some of these are already being rolled back. So, you discussed the tariffs we've seen rolled back against other countries. In Canada, we spent most of February and March talking about a $155 billion retaliation package. Only $95 billion of that was put in place. We did see tariffs imposed on motor vehicles last week. But just today as well, we've already seen some carve-outs to that last round of retaliation. So, now there are exemptions in place for U.S. car manufacturers who maintain operations in Canada. We've also seen some exemptions for other, manufacturing inputs. So, those are factors that are going to dampen the tariff impact over time. But what we'll be watching is just those goods that saw tariffs imposed in the month of March. How are those being passed through to consumers? And as we get a little bit further over the next few months as well, just, the 145% tariff on China is really something we haven't seen, going back a number of years. So how is that going to impact goods prices in other countries? Are we going to see more exports from China to other countries to offset the products that were meant to go to the U.S.? That type of, dumping is something that can reduce core goods prices in other countries. And if we are seeing inflation pressures from Canadian tariffs, just to what extent is that helping to offset it? So that's what we'll be watching over the next few months.
Okay, so bringing it all together, we've got the inflation numbers. We also have a lot of uncertainties you mentioned around tariffs. What can we expect from the Bank of Canada tomorrow?
So we look for the Bank of Canada to pause tomorrow. We've been looking for a pause ever since that GDP report we saw at the end of March. And I think the more important factor in that was a speech that Tiff Macklem gave on March 20th. So in that speech, the governor was speaking about just this environment of uncertainty and how difficult that makes planning, because if you plan for a central scenario and your assumptions are off, well, you can make a policy misstep that makes it more difficult to keep inflation near target. So the governor spoke about just perhaps being a little less forward-looking, so putting less weight on those forward projections, because they don't know what tariffs are going to remain in place for how long, and just the type of impact that's going to have on activity. So, to us, that suggested a higher importance on backward-looking data rather than trying to envision where the trade war might be, or the state of Canada-U.S. relations might be in 3 months, 6 months' time, and what the economy might look like. They're going to put a little more weight on recent data, and that recent data has been quite strong. Until this morning's CPI report, we had seen inflation come in considerably stronger. Monthly GDP growth over December and January has been considerably stronger. And even with that downside surprise on today's inflation report, both headline and core inflation are still considerably higher than the bank thought they would be in January. So, we think this does set up for a pause from the bank tomorrow. But with that signs that inflation pressures might be coming off, that should lower the burden for the bank to continue easing once they've got more evidence of the impact from tariffs reducing demand, and especially if they're not staring down such a large inflation shock at the time. You're going to hear a lot less talk of stagflation. This is going to kind of reduce the obstacles to cutting rates further once the bank has more clarity around tariff impacts.